Hey guys, Akil Stokes here, and today I want to give you an audio version of an article I've written for FX Trader magazine called Take Control of Your Trading: How a Shift in Mindset Can Equal a Shift in Results. If you're not seeing the results that you want from your trading, you have nobody to blame but yourself. Okay, maybe that's a little harsh, but I would bet that for most traders, it's true. Many make the decision to trade not just for the dreams of becoming wealthy, but because it offers a massive amount of control. Control over their finances, control over their time, control over their decision making, and ultimately control over their future. All of this can be achieved in the financial markets. Unfortunately, it rarely is. Excuses such as, I don't have the time, or I never formally studied economics are often used to justify the struggle. But the reason that so many traders struggle is because they lack control over their trading by lacking control over themselves. Taking control of your trading begins with understanding where you're at in your trading journey. There are 4 stages that a trader will go through, 3 of which are briefly explained below. Unconscious incompetence. This is the beginning stage of trading where you don't know what you don't know. Imagine a young child exploring the world with lots of curiosity and zero fear of the potential dangers that exist. Many traders will begin at this stage until they have the time to become more educated about the markets and learn from their mistakes. Conscious incompetence. Eventually, a trader will begin to realize that being successful isn't as easy as they once thought. Buying and selling at will won't get the job done, and the quest to acquire knowledge begins. It was at this stage when I first came across FX Trader magazine as I was scavenging the internet for as much information as I can find on the financial markets. Conscious competence. After finding a strategy, backtesting said strategy, and creating a solid trading plan, the trader now feels as if they have done everything possible to put themselves in a position to succeed. However, as their live trading begins, they still notice a few minor setbacks standing in the way of their consistent profitability. The 4th stage isn't too important because 90% of traders never make it past the 3rd. Many will quit when trading becomes difficult, and others will find themselves stuck, one step away from the prize in an endless cycle between the conscious incompetence and conscious competence stages. Being stuck in this cycle is very stressful and can consume a lot of mental energy. The trader feels as if they've done everything to deserve success, yet every 2 steps forward are followed by 3 in the opposite direction. Why? That's the main question that is often asked. And when no answer is available, blame is thrown at the markets, the broker, and of course, the trading strategy. This leads the trader to head back to the drawing board, searching for a new method for extracting profits from the markets, starting the cycle over once again. There's an endless number of profitable strategies that exist, and if your strategy made it past the initial testing, backtesting, and demo trading phases, then I'm sorry to say, but it's not your system that's all of a sudden failing. It's you. Believe it or not, most traders don't have a problem finding winning trades. In 2011, a study was performed by David Rodriguez and Timothy Shea, which looked at 2 years of data and over 12 million real trades from FXCM clients worldwide. The study showed that, on average, traders were correct more than 50% of the time. So instead of shifting blame elsewhere, the key to making a change is accepting responsibility and taking action to deal with it. Heading back to the study, if the average trader doesn't have a problem finding winning trades, yet 90% of traders never make it past the conscious competence stage, then what's holding traders back from success? This question was addressed in the same study, and it was found that of the sample size of traders, the average profit per trade was barely half of the average loss per trade. Knowing this data, it's easy for one to come to the conclusion that in order to fix this problem, a trader simply has to ensure that each trading opportunity provides them with a positive risk to reward ratio. However, I would assume that most traders are well aware of that. Yet, to this day, the problem still exists. So, if not that, then what? In my opinion, the problem lies not in the analysis that takes place before the trade, but within the trader's mind after the orders are executed. Money is the root of all evil. Many of you have heard this phrase before, and when it comes to trading, this certainly holds true. Financial gains and losses are a huge trigger for our emotions. Greed, fear, pain, shame, arrogance, anger, and depression are all feelings that are directly associated with the earning or loss of money. Close your eyes for a second and think about how your last losing streak made you feel. Were you angry that your hard-earned money was taken away from you? Were you scared knowing that you may end up losing more? Were you discouraged, depressed, or even in a state of panic as your account slowly bled out and you couldn't seem to make it stop? How about after your last winning streak? Did you become greedy and start holding positions past targets in an attempt to get every last drop of profit out of the markets? Did you become overconfident and start taking trades that you shouldn't have, believing that you've mastered trading and would never lose again? Were you scared, knowing that you've struggled in the past and are now wondering if this current winning streak is simply luck and not skill? These are the feelings and emotions that surround every trader each time they put money at risk. Successful traders learn how to control these emotions, while struggling traders allow them to influence their decisions, resulting in the self-sabotage of their trading results. The connection between emotions and money comes from one's core beliefs that were instilled in them from a very young age. Therefore, it would be foolish to assume that they can easily be changed overnight. Just like a bad habit, getting rid of these beliefs and emotions shouldn't be the goal. Rather, the focus should be on how to replace them. Process over outcome. In order to make a change, a trader must shift what gives them pleasure and pain. Typically, pleasure and pain are directly related to the outcome of the trade. A profitable trade will provide the trader with pleasure, while a losing trade causes the trader to feel pain. The same can be said for how good and bad trades are defined, with good being used to describe a winning trade and bad being used to describe the trade that loses. These associations are based off the outcome of the trade, something that we have zero control over no matter how great our system is. Instead of punishing or rewarding ourselves over something that is out of our hands, we need to focus on controlling what we can control. And that's the execution of the trade. A system or strategy with a positive expectancy means that the trader has an edge over the market. It's impossible to predict the outcome of any given trade, but when trading with an edge, we can be quite confident that the long-term results will be in our favor. Therefore, the only job is to consistently execute the system or strategy day in and day out. For a trader with this type of mindset, pleasure and pain are no longer based off of the outcome of any given trade. Rather, they're strictly determined by whether or not the trader has followed the correct process for executing the trade. Win or lose, a good trade is defined by the trader following their rules, and a bad trade is defined by the trader making a mistake. Eliminating mistakes. The Japanese have a philosophy called Kaizen, which means continuous improvement. After World War II, they implemented this philosophy/management concept into many of their factories, looking to take a slow and steady approach at rebuilding their economy and industry. I took this same approach with my trading, and in late 2010, I looked myself in the mirror and decided that I would no longer concentrate on winning and losing trades or profit and loss statements. Rather, my single focus would be on eliminating my trading mistakes. I knew that a task like this couldn't be achieved overnight, so I made it a goal of mine to end each month with at least a single less mistake than the previous month. That meant that if I made 20 mistakes during the month of January, then my one goal for February was to make no more than 19. It was a lengthy process, but as I slowly started to reduce my trading errors, my account started to grow as a direct result, and more importantly, so did my confidence. Unconscious competence. This is the final stage of trading, where a trader seems to be running on autopilot. Trading has become somewhat boring, and monotonous due to the fact that a trader is analyzing the markets and executing the same type of trades day in and day out. The rush that comes with being up big is rarely there, and the emptiness that comes with being in the red no longer has an effect. All that matters is the consistent execution of the trading plan. And if you can completely control that, then you'll have full control over your trading future. My name is Akil Stokes, and I'm the Chief Currency Analyst as well as the Head Trading Coach over at TradingPower.com. And I appreciate you guys taking the time to listen to my words. Hopefully, something in this article will help push you on the right path of becoming an independent, consistently profitable trader.